Tell us about your approach to investing.
So I'd say the first thing that I really solve for is downside protection. I sort of build up a long-term expectation for a company that then translates to numbers, that then translates to a stock price that I can get comfortable with.
So you knew you wanted to be an investor really early.
A little embarrassing to say, but I was the president of the Wall Street Club. I think I was the only student in our school that had a Wall Street Journal subscription that was delivered every day to my dorm room. I think we are in a different paradigm today than we've been in times past. There's winner-take-all economics in a number of the industries. Examples, power production industry. That is partly driven by the AI thesis, but it's also partly driven by EV adoption. Regardless, over a 10, 15, 20-year period of time, I think we will be at a long-term shortage of power in this country such that there should be good pricing power there.
Today, I'm joined by Will Robbins. Will's an equity portfolio manager based in San Francisco. He also oversees our solutions group. He's been at Capital just shy of 30 years. Will, welcome. Thanks for joining us.
Thanks for having me.
So Will, you bleed Kentucky blue in lots of ways. So we're going to start in Kentucky and make our way forward. And Kentucky's known for a lot of things, right? It's the bluegrass state, I think birthplace of Lincoln.
That's right.
Bourbon, but also horse racing. And you're a big horse racing fan. You grew up a big horse racing fan. Take us back to how you started off in that, how you were interested in it, how it informed some of your early thinking about investing.
Well, thanks for having me, Mike, and I appreciate the question, as I always like to talk about my Kentucky heritage. And the horse track experience goes back to when I was a young child. My grandfather used to take me to the track. He would give us a couple of dollars, me and my siblings, and sit with us for several hours and help us guide us through the wagering process, which, of course, at that early age, he was making the wagers on our behalf. But it taught me this.
Is that legal?
Well, as long as he's the one that goes up to the windows, which he was, but he was. I think he was intentionally trying to teach us a lesson around risk management, around money management, around just being careful about how we allocated our bets, because of course we're going to be there for 4 or 5 hours, and the last thing you wanted to have happen is to run out of money after the first race. And so he would put together, or we would put together bets that would then, he would make. And oftentimes they were show parlays, which is probably one of the safest bets you could make at the track, but it was something that would help us make a little money and not get wiped out if we were wrong. And so.
And how old were you at this time?
I was in my mid-single digit age range.
7,
so it was
8,
a very, probably even a little younger than that. So sitting on his lap watching the horse races. And this was one of my fondest memories of my grandfather and the time growing up in Kentucky, is at a very young age, going to the track. And what's important about the experience is it taught me this notion that you could get paid for accurately predicting the future, which was so powerful at the time. I didn't realize that there were professions that translated into the same. And of course, we take great strides, no pun intended, but we make great strides here at Capital not to equate the act of gambling to the act of investing. They were very different. And frankly, that was also taught to me at a very early age, because after having gone to the track for probably a decade in my middle school or a little later, my grandmother gave me a look at her stock portfolio. She had a stock portfolio that she'd inherited, and she wanted me to take a look. Thought I could be of help to her.
And you were a teenager at
I
this
was probably 14, 15 years old. And when I took a look at it, this is when I came to realize that every bet that you make at the track, the takeout is about 20%. So the odds are stacked massively against you for that endeavor. Whereas the long-term returns in the U.S. stock market, many stock markets, the U.S. is the one that I looked at the time, was positive 9 to 10%. So effectively you got, the house odds were in your favor. And so it was a really important insight to why I then went in search of being able to do something that I loved at an early age.
And so that was investing. So you knew you wanted to be an investor really early. Before you went to college, you had a sense that investing was something you were going to do.
I did. I was the president, a little embarrassing to say, but I was the president of the Wall Street Club.
It's a safe space.
Thank you. I was the president of the Wall Street Club in my high school, and actually it was a private high school that had a decent endowment for the size of the school and at that time, and the treasurer of the school actually allowed us to allocated just a little piece of that portfolio for the purpose of letting us make stock picks. I paid for spring breaks my senior year in high school with a stock pick. I was the only, I think I was the only student in our school that had a Wall Street Journal subscription. Of course, it was hard copy at that, paper copy at that point in time. It was delivered every day to my dorm room. So I was interested at a fairly early age and pretty passionate about it.
Excellent. All right, we're going to fast forward to Capital Group, and we are glad we have you and you're not at the racetracks in Kentucky. You saw the bank crisis of 2008-9 firsthand. And when Silicon Valley Bank was going through rough troubles a few years ago, you were pretty early in saying, this isn't that. This is not the global financial crisis 2.0. What gave you that sense of security that this was different?
Well, maybe a little context would help to start the answer, which is I'd been a bank analyst since 1996 at Capital. Actually, right out of college, I had joined a financial institutions practice at an investment bank. So I was kind of slicing and dicing balance sheets and income statements for financial institutions from really my first job out of college. And so I got to see, I think about it now as an opportunity. At the time, it didn't feel as such, but I saw the commercial real estate crisis in the early 90s. There was a consumer credit crisis in the late 90s. There was a commercial credit cycle in the early 2000s, and of course, the global financial crisis. They were all patterns that applied, or pattern recognition that you can see there are factors that apply to those crises, some of which applied to the 2023 moment, but many of which did not. One of which is that there were no great excesses. I mean, to the point where we had, as we remember, the loan practices of the large banks in 2007 or 2005, 6, 7, leading up to the GFC, the financial crisis. That was not something we'd experienced in the early 2020s, for example. We had a few banks that had mismatches in terms of the way they managed their balance sheet. No surprise, when rates went up, those mismatches were exposed. There's a couple of other things that I think were important to note, though. One is that the size of the institutions were not of the same sort that were being called into question, of course, back in the global financial crisis.
Those are the biggest financial institutions, and Silicon Valley Bank was much, much smaller.
That's right. But what was similar was the rapidity with which the funding for those banks disappeared, just like they did for the very largest banks in the global financial crisis. So in 2007-8 time period, there was an ease of pulling overnight funding, which really was the cause of the crisis at the very darkest moment. And I should add that the pattern that applies across all of the financial crises where we get to them is they start with an earnings issue, become a capital issue, and then land in the darkest moment as a liquidity issue. And they usually work their way out the same way, from liquidity to capital to earnings.
Right. That's really well put, by the way. I don't think people realize that process.
Yeah. Well, that's similar for every crisis. And so you have to find a way to stop that liquidity crisis from happening. And so the big thing that I point to for 2023 is the regulatory response. The regulators learned many, many lessons through the prior crises, and in particular the 2008 crisis, and recognized they had to draw a firewall. And the firewall they drew was twofold. One, they protected the depositors of the failed institutions, so they did not force a haircut on depositors.
Even in excess of FDIC.
Even in excess of FDIC insured. Right. So effectively, they were declaring even the smaller regional banks as systemically important. That's a critically different approach than, potentially for the overnight funding community to have the option of making a few basis points overnight or losing it all. So the decision there is very clear. They would pull their funding. In this case, if depositors felt like they had some sort of guarantee that they would actually get their money back, then they could have confidence to keep their money in that institution.
So there wasn't a run on the bank.
There was at the beginning stages, and then the regulators drew that firewall. The other thing which I thought was fascinating is they actually raised capital. So we had, 2 or 3 failures in the early days, and then there was one bank that sort of stayed on a lifeline for a period of time that was causing a lot of consternation in the investment community, at least among us, both current and former bank analysts, and I'll just name it as First Republic. And that was a company that we weren't sure how it was going to be resolved, but the good news is they didn't resolve it in a discontinuous, messy fashion. They let it go. They found a buyer in the form of JP Morgan. In the meantime, before they found that buyer, they actually had JP Morgan, Citigroup, B of A, a number of large banks put a capital injection into the company and effectively, that was another firewall saying, if you let this go, and depositors like JP Morgan, B of A, et cetera, lose their deposits, then they become at risk potentially. They become capital shy. So that was a way of essentially extending that systemically important designation to First Republic in that moment. I thought it was a brilliant way of handling the situation.
So let's talk about your investing approach. You, as I think folks can already tell in a few minutes into this discussion, are disciplined. Tell us about your approach to investing, because I think it's pretty disciplined in nature, and I think it would shed a light on how you think of broader long-term opportunities. So what is that approach?
Well, I'll probably start by saying it was colored by the fact that I was a bank analyst through a number of crises for almost 2 decades and had exposure to the industry for over 2 decades and almost 3. So I'd say the first thing that I really solve for is downside protection. And there's lots of different ways to do that, but that is something that's near and dear to my heart, is not to incur permanent impairment of capital. I talk about the tyranny of negative returns. If you're down 30% in the next bear market, you got to be up 50% on the other side just to break even, and that just seems like a heroic, kind of expectation. So I'm endeavoring not to go down 30% in the next bear market, for example, or something better than the bear market. As far as how I get there, I have to, and this may relate to your comment around being disciplined. It has to be quantifiable. That's probably my hallmark.
Your downside.
Well, no, I say the investment opportunity writ large has to be quantifiable. So both opportunity and downside. So upside base case, downside case. I want to be able to put numbers around it. I have a very hard time with storytelling as a kind of contrast to the way I think about it. I think a lot of our portfolio managers do the same, but I am particularly focused on that downside case, the probabilities I assign to that, the outcomes that are associated with that. That's how I do it. I sort of build up a long-term expectation for a company that then translates to numbers, that then translates to a stock price that I can get comfortable with.
And so talk about the theory of consensus around that. You're building your own upside scenario. There's consensus out there for most of the stocks where people will say, well, the upside's X in the next 3 to 5 years based on the consensus of models. How does consensus, do you look at that? Do you care about that?
I do, but keep in mind, consensus usually only extends for a couple of years.
Right.
And our time frame, the turnover in the portfolios for which I'm responsible for is probably less than 20% on average.
Right, so you have 5-year time frame.
5+ year time frame for holding as a holding period. And so you're not going to get a lot of 5-year consensus expectations. But I often say, and I was a research director, we didn't mention this as part of my background, I was a research director for roughly 15 years of my almost 30 years at Capital. And I often would tell analysts the phrase, the least proprietary thing we know about a company is its PE ratio, its valuation on consensus earnings. Anybody can do that simple math. What we need to understand is whether we believe in that consensus in the early years and what the out years might look like. So the conversations that I have with our analysts often go like this. What does the world look like for this company in 4 or 5 year time period? Right. And in turn, how do you think that they're going to value, like the world's going to value this company given that setup? So if the company has already expanded to the point where it's sort of fully penetrated its addressable market and its growth rate is dramatically slowed, then we know it's going to carry a lower multiple and we can discount that back to current price. If there's still a very long runway of opportunity, then we could put a higher multiple on it as long as we have a confidence that they are able to capitalize on that growth opportunity.
Got it. So managing for downside, do you, because you're not always right, do you effectively have a stop loss? I mean, if something's down 20% and something may have changed, how does something work its way out of your portfolio, either on the upside or downside?
Yeah, oftentimes it's a thesis change. I was wrong about the moat. I was wrong about the opportunity set. I was wrong about the long-term growth rate. It's not necessarily a stop loss, but certainly if the market is telling me I'm wrong, I have to do more work to make sure that that thesis is still intact. And so that's where I try to spend time with analysts and try to do my own own soul searching to say, was I wrong about this, or is this just a moment in time? And of course, you can go either way. And oftentimes I will start a position at a smaller size. And if the market is telling me I'm right, I'll actually add sometimes. And if the market is telling me I'm wrong, I have to decide, is that an opportunity to increase my position or to recognize my error, my mistake, and move on?
So stylistically, you have everyone has a different style, but that fits in the capital system in a certain way. And the capital system, with portfolio managers expressing their strongest conviction with the research portfolio, all likelihood in a strategy. Tell us a little bit about how you think of your role inside the capital system.
Yeah. Well, once again, I think that is that I'm looked to, and perhaps my reputation internally is one of being a downside protective portfolio manager. So I am looked to in those darkest moments to have not performed or to have results that mimic the market, but to do significantly better. That's where I tend to thrive. It's not that I'm rooting for a bear market, by the way.
But you tend to protect capital.
But that's what I tend to do.
Capital and capital.
I mean, I would say the phrase that I use is I try to win on defense.
Right.
Or win with defense. And that is what has served me well for a long period of time, although it's not always in favor. As you know, when we're reaching new highs each and every day in the current environment, it's a little less attractive, but I know it will be valuable at some point in time. It always is. It's a little bit of that experience of seeing bank crises come and go. We know that bear markets will come and go. And when those bear markets come, that's where I think the broader investor community at capital will call upon me to serve a purpose.
When you think of the mistakes you've made, has it by owning a melting ice cube too long and then you're left with water?
Well, on occasion,
I
think the more likely mistake is that I am wrong about the fade rate on a melting ice cube. In other words, I didn't think it was a melting ice cube, and it turns out that the moat wasn't nearly as wide. There's a disruptive factor, whether it be a new market entrant or a substitutive market entrant, that has taken the opportunity set away and actually caused the growth rate to go from something that's positive in nature to something that's negative in nature. I have real-time examples. We can go and get into them if you're curious, but I think that's where I tend not to be, when I'm looking at the quantifiable nature of a company's prospects, to have to be very disciplined about applying my moat framework and sort of making sure that the company isn't at risk or at threat of an existential challenge.
So give us an example. I mean, you offered them up, and our folks who listen and watch, they love to hear examples of mistakes made, because all of our investment professionals are human. Some are pretty superhuman, but they're human.
Yeah.
And give us a mistake that you made where you didn't realize that moat was breaking down quicker than you probably thought.
Well, I think one example that's real time is the cable industry. And by the way, I still hold the cable industry. I think it's a very attractive. This is not where I think the moat has completely gone away, but it is one where it has been called into question. Part of this is cyclical. So there was a pull forward of broadband connections during the COVID moment that clearly increased their subscriber growth. Part of it is challenged by substitution, fixed-based wireless opportunities, and I think, and other potential satellite, et cetera, other ways of getting your broadband. And other parts of it, I think, are just simply misunderstood by the market. For example, the value of a cord cutter. The supply of video is not a terribly profitable act on the part of the cable companies. That's captured a lot of headlines, but if the economics that I understand to be true apply over time, I'm okay with losing video subscribers. I want that broadband subscriber growth to return. The market called into question that subscriber growth. The multiples went to sub 10 times over a period of time, maybe several years post-COVID.
Right.
If you believe in no growth, then once again, going back to those, what multiples would you pay? If you just believed that it was a bond for perpetuity forever at 10, and you wanted a 10% return, you would pay 10 times. So what the market is effectively saying by pricing it at something less than that is that these companies are in permanent decline. Maybe not fast decline, but permanent decline, X growth. I do not believe that to be the case. And so it's one where it's
so really— So consensus is the glide path is in
is negative.
And you believe will be better than that.
A slow burn.
Got it. Okay, I want to get into a couple things. I want to get into your investment edge, some of your ideas today. But before we do that, I do want to go to our office treasure hunt. And I love all the office treasure hunts equally, except I really love this one. Okay, so I have a little something here that I think it's amazing. So I'm going to ask you to read something for our group. Now we have listeners and viewers. For the viewers, it is on the screen behind us, and I'll give you a framed copy of something, and I'm going to ask you to read that for everyone. Yeah, I took away your glasses before we started. You want me to read it?
No, I got it.
Okay,
I got it.
Ahead.
So I'll just read from the top. It was dated March 9th, 1994. I was at business school interviewing for summer internships at the time in various investment firms. Dear William, thank you for taking the time to meet with Greg Wendt on campus on March 3rd, 1994. He enjoyed meeting with you and appreciates your interest in the Capital Group. The combination of your education and experience is impressive. I appreciate that. However, upon review, we do not feel there is a sufficient fit between your interests and background and our organization and its needs, as they now exist, to continue discussions. Thanks again for taking time from your schedule to accommodate ours, and best wishes in your pursuit of a challenging and personally satisfying career.
So a full-on Capital Group rejection letter, framed, and you still have it for obvious reasons. So despite this, you're here, and you've been here for almost 30 years. How did you turn a rejection letter into a 30-year plus capital career? Because you got a lot left in the tank.
Yeah, well, I did get the call. Well, I'm not sure it's that important, the specifics of the situation, but I will describe them, which is I did get the call back a week later from Greg Wendt, who had been my interviewer on campus the prior week. And he said, we'd like to come back and revisit our decision, and we'd like to have you come out. So it was a change of heart on the part of Capital that thankfully led me to, again, almost a 30-year career at the company. The things I take away from it, though, and I think are important as observations, are one, I do keep it literally right above my desk. There's a shelf.
Oh, I saw it.
Yeah, maybe 5 feet above my screen where it sits. And it's a reminder of, it keeps you humble. Just keeping that in mind and keeping the humility in mind that letter reminds me of every day, I think is helpful for the purpose of what we do.
And Greg's not too far away from you in San Francisco. So I'm glad, Greg, if you're listening, thanks for calling him back. Alice Davidson, I think, was here.
That's right.
She called you back. So we're glad you're here. Let's pivot and talk about your investment edge. I'll get into ideas in a minute, but what is your edge that's different than others, that's very unique to Will Robbins?
Yeah, well, as I said, I think the first thing I would start with is I try to win on defense. And so what that means, and combined with some of the mistakes that we've heard, the lessons learned that we've heard already, I think one of the edges that I bring to that endeavor is to stretch out my time frame, to ensure that my time frame is capturing the full plethora of opportunities and to be able to quantify those in a way that will get me excited about a stock. I think that's an exercise that, just in the time frame exercise is one that not everyone in the investing world takes on. And then trying to quantify that is as well, sort of the non-storytelling approach, but really trying to put numbers to paper and thinking about what it means for the investors in the companies in my portfolios is where I feel like I really have an edge.
Yeah, win on defense and time. Rob Lovelace was our first guest on this podcast, and his investment edge was time.
Yeah.
And the fact that the primary driver of a quantitative investment bonus for you and other investment professionals is 8 years gives you that time. We talked about 5 years, but it's 8, 5, 3, 1, 8 the most important, then 5, then 3, and then 1. You have the time to be right. And I think that's a good combination.
Can I just add to that?
Add.
It's not just the way in which we incentivize our investment professionals. It's also the way in which our investment community asks us to do our jobs. It's a critically important element to what we do. We have confidence not to have our capital pulled at exactly the wrong moment. And so I think we owe a debt of gratitude to the investment community, to investment advisors who are counseling their clients to stick with us through thick and thin. That's very much appreciated.
I do think that helps us. It helps our time frame. And when one of our 5 core values is long-term, it's aligned with our clients. It's aligned with our time frame for investment professionals to generate results. It's a whole ecosystem that works together.
Yeah.
I think that's well put. some ideas. Give us either a theme or a stock that you're going to hold for 5 or 8 years. If you had to guess now, what's on your mind?
Well, there are stocks I have held for very long periods of time. Some of the best companies within the industry I covered, although I'm not going to point to those as being the greatest of opportunities. I think there is some cyclicality there that we have to be aware of and invest around, but there are long-term holdings, and JP Morgan would be a good example of that. But let me talk about sort of the here and now. Of course, we know the concentration of the market and the success and opportunity that many of the very largest tech companies have capitalized upon. And I too hold a number of companies in a fairly sizable weight, maybe a little less than some of my peers, even within capital, as a result of, again, trying to translate those quantifiable returns to a current stock price. In some cases, it's hard for me to make sense. I was brought up in a world of where trees don't grow to the sky was the mantra. And while I still believe that's true, I think we are in a different paradigm today than we've been in times past, where there's winner-take-all economics in a number of the industries. And so I still have confidence that there is a very long runway for some of those companies. They're not monoliths. I think I heard Mark Casey say that on a podcast previously, that when you think about the Mag 7, or however you want to define that very concentrated portion of the market, some I find to be very attractive and reasonably priced and easily translatable into an attractive return profile with reasonable downside protection. And others are a little less attractive to me at this point based on either valuation or what I consider to be a long-term assessment of their moat.
Right. That makes sense. I think that's why the whole name Mag 7 does a disservice, because it's not an index. They're individual companies that comprise a list of stocks, and you have to do the research on which ones have that runway and which ones may be more fully valued. And I think it could be lazy to just jump in and say, I want to own 7 names that were put together to make a quote unquote Mag 7.
Right. But there's a lot of themes around that, either whether it be digitalization or AI context, that I think are really interesting opportunities that don't carry these headline eye-popping multiples. Examples, power production industry. I think there's insatiable demand, and our analysts have been very, very good about highlighting this from a very early stage, that there's an insatiable demand for power, certainly in this country. That is partly driven by the AI thesis. It's also an expansion, but it's also partly driven by EV adoption. And I think both will likely, we can all put our numbers around how quickly that adoption rate, for example, in EVs will take place. But regardless, over a 10, 15, 20-year period of time, I think we will be at a long-term shortage of power in this country, such that there should be good pricing power there. How about enterprise consulting? I'll just give you a single stock that I've been really interested in, which is Accenture, which is, has changed its business model over time to adapt to the needs of the enterprise, of its clients. It was, putting together offshoring plans for many companies in the 90s and 2000s. It was big data was what they called it, 5 or 7 years ago. Now it's AI, and they're actually helping companies like ourselves with the challenge of figuring out where the opportunities are, where the low-hanging fruit is as a starting point, and where the ROI opportunities are for applying AI. And so that's a good example of just investing around the ecosystem as opposed to right at the heart of it in that stack of opportunities in the AI space.
The other ones, both are good examples of that. Power generation, you don't necessarily need to own NVIDIA to benefit from the generation of power that will be required for AI. I heard something, this might not be exactly right, but one search in ChatGPT is the equivalent of a light bulb being on for 15 minutes. It's a single search, and there are millions and hundreds of millions of searches, and it gives you a sense of the demand that's required. And a lot of those stocks will have reasonable valuations and probably pretty good yields as well.
That's right. So I have a lot of exposure in the industrial sector around that ecosystem, have some exposure in the utility sector around that ecosystem. So those are good opportunities to take advantage of this mega trend without having to pay those eye-popping multiples.
All right, we're going to do one last pivot before we wrap up, and that is Capital Solutions Group, CSG. So the Capital Solutions Group, one of your responsibilities here is to oversee that group. Can you tell us what it is. It has about, you'll correct me, but about 500 billion of assets that it oversees for clients. But what is CSG? What is Capital Solutions Group?
Yeah, the 500 billion is about right. And it is our effort to solve for client needs in a way that brings together a number of our strategies to deliver an outcome. So we call that objective-based investing. And so we are highlighting or identifying important objectives that investor clients bring to us, and then packaging our strategies in a way that delivers upon that objective. That may be defined by total return, but it also may be defined by risk-adjusted return, or by income, or by max drawdown. So we put together a set of success metrics to describe what we want to accomplish, and then we quantify those success metrics through multiple runs, many runs on potential portfolios to identify best fit for that purpose. And we then deliver these packaged strategies in a way that can either be fund to funds or can be models.
The group does a wonderful job. I hope they're listening, because we give them a well-needed shout out, and I'm sure they'll appreciate it because they deserve it. And thank you for taking the time to lead that group as well.
Absolutely. It's my pleasure. And I do too want to shout out to the unit. We have a number of investment professionals that have dedicated their lives to building solutions for our clients. And I will say that it extends beyond just the delivery of the portfolios, but it's also the counseling that comes with that, the thought leadership that comes with that. And now increasingly, I suspect there will be more customization that comes with that I think the group is well prepared and well suited to deliver upon.
Got it. Give me one mentor. And when I ask this, people start listing 3 or 4. I'm going to push you to 1.
I would have listed probably 5 or 7.
I know. That's why we're doing it this way. Give me
think
1.
Maybe I'll just give, maybe I'll just name Darcy Kopcho, who retired from Capital a number of years ago.
Had served on the Capital Group Management Committee when I had joined.
Yep. There's so many, it's hard to isolate, but I'm just going to give you your one.
Thank you.
Darcy would be maybe my starting point and ending point, because she, firstly, as a portfolio manager, taught me the value of downside protection and the importance of dividends. And so that was in the mid-90s and early in my career at Capital, where I was involved with an Income Fund of America as a way to understand just what it meant to have dividends as part of the total return calculation. Subsequently, she was, as you mentioned, on the management committee. She was a research director. She was very much involved in people management, and I think she was one of the more gracious, empathetic, and tough leaders that we've had at Capital.
Yeah, she's amazing. When I see her at some of the retirement dinners for some of our associates today, I always give her a big hug, and it's great to see Darcy.
Same here.
I'm going to finish up here, Will, with the world's largest mug. And this is our gratitude mug, and a lot going on in the world today. So we do have to remind ourselves that we're grateful for things. What are you grateful for as I give you a mug to take away? What's something could personal, professional, anything on your mind?
I would say large coffee mugs. I am a coffee drinker, so thank you for that. But maybe more to your point, I'm grateful for family. You mentioned, this is going to come full circle with Kentucky. You mentioned my early childhood and experiences that I was provided. I really am grateful for my growing up family and all the lessons that they taught me around the importance of family, being there for one another, the importance of integrity, honesty, hard work ethic, good work ethic. It was incredibly nurturing, but high expectation, at least in terms of personal quality environment that I grew up in, and I appreciated that. And then I've tried to do the same for my family in turn. I have 3 children, a wife and 3 children. I say children, they're all young adults in their 20s at this point, and I hope that I'm able to pass along those same qualities and that same, in a nurturing fashion, but also hold them to high expectations around their own personal attributes. I feel like I've at least had some success in doing so, and I'm super proud of my kids and my wife and all that they bring in their efforts and hard work and independence of thought, which I really appreciate about my immediate family.
Well, when your biggest smile of the podcast comes when you're talking about family, you're doing something right. And I'm also happy you're part of our Capital Group family, and that rejection letter was only temporary. And you've been here for 30 years and going strong. Thanks for joining us, and please subscribe to Capital Ideas on YouTube or wherever you get your podcasts. Have a great day.